Oh, hi, good morning, sir. Thank you for accepting the interview request. And I'm really fortunate to have Mr. Jiten Parmar, who is the co-founder of Aurum Capital. He completed his BE in computer science in the year 1990. He worked as a software engineer in the US. And then in 1995, you co-founded a Java consulting firm, which you basically sold off in 1998, 99. And then you returned back to India in 99 and started your own enterprise. And then I think in 2018, you started Aurum Capital. So he has a very rich experience of investing in both US equity markets as well as Indian equity markets. A very, very knowledgeable, a very humble person that I've known, especially in this industry. And basically, he likes to he's someone who basically likes to share his knowledge. If you look at his value picker threads, also some of the forums that he has talked on, sir, first of all, sir, I would like to congratulate you and really say thanks that some of the videos that are present on the YouTube and on some of the threads, like really help a novice investor to learn. Welcome.
Thank you, Shubham. It's great to be on this platform. I wish everybody a very happy New Year 2022. Hopefully, it will be better years on the personal front for many than the last couple of years. As investors, we didn't have to complain in the last couple of years. They were probably the best years, but on personal front, it has been challenging for a lot of people. So I hope on personal front, 2022 will be better. And I do expect on the investment front, 2022 to be a bit challenging. But anyway, that's how things go. And looking forward to answering all the questions which you have on our side of investing, which is value investing, and specifically the work we have done on cyclical investing.
So first of all, I would like to bring a disclaimer that whatever we talk here is mostly for educational purpose, and none of the stocks or any sectors that we talk about is a recommendation of any sort. So yeah, just wanted to bring that up before we actually start the discussion.
Yeah, absolutely. I mean, I would not be naming any stock, but even if something comes up as the example, it should be treated only as example. There could be current investments, there could be no investments. If I have it, I might sell it tomorrow or whenever the market opens. But just everything is for educational purpose. And most probably I will be refraining from naming any stocks.
Right, sure. So before we start, I'll just give an outline of the entire session. So we'll start with talking about some general questions related to your past experience. Then we'll dive into your investing process and your key learnings. And then basically the goal is to get a good understanding for anyone who wants to learn about cyclicals, to get a very good understanding about what are the resources to look at, what are some of your key learnings, and how should one approach investing into cyclicals. And then we'll talk about some sector level questions and some questions that I got on Twitter from various people who basically follow you and some who follow me. So yeah, that's what we'll be discussing today. So okay, let's dive deep into the session. So the first question I had, sir, it's more of a personal question. So basically, what made you return back to India and basically start your enterprise, and then basically becoming an investor and an advisor?
So it's like, I'm quite attached to my family. All my family is here. And even though I went to the US, I got an opportunity very early in my career to go to the US. And I always had thoughts of returning back. And basically, since we sold our company, it was very easy for me to, basically just move back, because either I could start something new again there or return back in India to something. So it was very, sort of a clean break for me. at the right time to come back to India too.
And so just wanted to bring something up, and this is the reason I feel like really attached to you, because our journey is very similar, just that I'm in the starting phase. So I also went to the US, came back like last year, and now left my job and now in full-time investing. So yeah, just something off topic. Uh, so the next question I had was, I looked at your Twitter profile and you shared that you basically had a stock which became a 500 bagger, right?
Yes.
Right. So I want to know, because it's like fancy, even like not many people get 100 bagger in their lifetime, and you like have something. So even though it's like something that on your personal front, but essentially something that you can talk about, and how did it happen? And I don't want you to name the stock, just that what was, so because in the overall process there would have been like many ups and downs. It's not like it would have just gone up. So what made you give the conviction to hold on, and how did it happen?
So luckily, the thing is, my entry point was when markets were really bad in that sense. So it was a very, I mean, nano cap when I entered, and probably it didn't correct much from when I bought. Of course, from my buy price. So I bought this stock in 2004, and then we had a great run till 2008, and then corrections and all. But that stock never, basically almost never touched the value at which I had bought it. So that was one thing which kind of really helped. And then over the years, I saw the company kept on growing, and I just somehow, latched onto it. There were some concerns regarding some some diversification, but I kind of still took it in my stride and understood why it was done, and just held on to the stock. I think a lot of people sold at that point in time, but I kind of held on, and I think the greatest gains came after that event actually. I'll tell you the journey in that sense that for the first many years, I think for the first decade, it didn't give as great returns what it has given post that. Just a normal performer kind of. But then I think since 2014-15 or something is when the expansion took place, and this stock is, I mean, I've had a big ride. I mean, this stock was was 200 rupees, around 200 rupees in the COVID lows, and then post that it went up to 5,200, and again now it is at 3,600, 3,700. I don't even know what price it closed at. But the thing is, the journey has been, when you got a winner, you just sit tight, and that's what. As long as the company is performing, growing, there will be phases where growth might be slow, or there could be some near-term challenges and all that. But if you have the faith in the management, and if the valuations are absolutely not bonkers, still hold on. So this stock, as I said, I mean, I tweeted some time back, this is my 250x, and then it went to 650x, and it might be now 450x. So this x is actually kind of, change so drastically. But I'm still holding, obviously, and as long as I'm comfortable holding at the valuations it has, and I see growth in the company, I intend to hold on.
So I think one subsequent question I had related to this was, a lot of investors, basically so in any investing, if you hold the stock for so long, right, during the journey, there are phases where essentially that, okay, over the next 2-3 years, it won't go anywhere, right? And there is an opportunity cost associated, and people try to like jump the gun from here to there, and okay, this looks better. So like, how do you end that? How did you not have that temptation of like basically deploying your money into something else? Yeah.
Yes, absolutely. So again, luckily I've been able to hold all my initial quantity at different points in time. Even if I have sold some of that, maybe 20% of that or something, I have covered it and more during these phases. So yes, there have been some obviously some action in the stock. I've sold some, I bought this thing. I think last time, I sold something at around 750 or something, and I got back again at around 225 to 250. So all these things have happened, but my quantity has only increased over a period in time from my initial buy. So in that sense, yes, I've had, I mean, my cost is obviously negative, uh, but yes, I have, and it's a fairly large portion in my portfolio. Uh, Still, I mean, not to the extent that it will be around 20% of my portfolio currently. It has grown to that. See, again, I just want to tell about this, that, with the same stock, there could be different outcomes for different people.
Right.
Imagine somebody who would have bought at 5,200, which was the recent high, something. For them, the outcome right now at 3,600, it will look completely different than the outcome for, somebody who's invested from earlier rounds. So same stock, different outcomes. It's a fact of life. So when you get in, and is important, and if you have the conviction, then even if you got in at the wrong time, you can always, if you understand the story, and if market gives you an opportunity to buy at lower levels, one should this thing. It has always worked for me.
Mm-hmm.
So again, it all depends on your conviction and understanding of the company and the sector.
Right. So I think one big point that I got from whatever you said is it's easier to hold on to profits, slightly difficult to hold on a stock when you are in losses, right? Or if you basically don't understand, and it also depends on like how well you understand the business, obviously, and your conviction level. But yeah.
Exactly. I mean, see, it is. I mean, to be honest, most of the times I actually love when the stock I buy goes lower. This is a very honest admission from me. That a lot of people want the stock because I don't buy everything in one shot. My style of investing is that I keep on buying slowly. I keep on developing conviction, understanding the story better, and so on. So if my conviction grows, and if I'm able to buy at a lower price, I'm actually happy. So I'm happy if the stock goes down, because I can buy more. And that's how I am. It could be completely different for different people. Some people will panic if the stock goes down. Again, we are all wired differently, and I kind of have that temperament. And it has worked for me. So there will be a lot of people who will tell you that always average up, never average down. So for some people it will always work if they average up. For me, it has worked both ways. I have averaged up also in my career, in my life. Even now I'm averaging up in quite a few stocks, and I've averaged down too. As long as you understand business valuations and you're comfortable investing at any point in time, you also have to understand the market cycles. And so sometimes in different market cycle, it could be valued higher, and your entry point could be different. That's why always I said, you don't put your whole body in the door. You always put your foot in the door, and then keep on understanding, and keep on adding is what my style is.
Right.
And this, see, again, it being a large part of my portfolio, is you have to understand that for somebody buying a 20% position in it, okay, of their portfolio, it is very different than for somebody whose it was, let's say, 2-3% of my portfolio and has grown to 20%, right? The risks are completely different.
Right.
We have to understand that, because it does affect mentally. If you buy 20% into something and it corrects, let's say, 40% from there, it will affect you mentally. Whereas if it has grown from, let's say, 2%, 3% of your portfolio to 20%, and if it corrects from there, 30% or 40%, it will affect you differently. So that you need to understand.
So since you are on that topic, so just wanted to understand your style of investing. So what is your portfolio allocation strategy when you invest into stocks? Do you like start very small, like 0.1%? Do you start like at least 1-2%? So how, and basically how do you allocate?
Yeah, I think 1% is minimum I would allocate.
Okay.
If I can't invest 1%, I will not invest. That is the start I will
Okay.
have.
And what is the
And
max that
since
you go?
so as I said, with my portfolio size and all that, if I have to buy into a new position, I don't think I can buy more than 5-7% of my portfolio. This thing. I would rather buy 5% and let it go to 20%. That would be just because I have legacy positions. For example, this stock is 20%. There could be other stocks which are 7-8%, 10% of my portfolio, which I'm holding for a very long time, and they've kind of grown. So, and if you don't want to tell that, you can't go beyond 100%, right? So,
Right.
so any new position, I think I can buy up to 5-7% is what I would look at if and then I would want it to grow to, I'm fine growing to let it grow to 20% of my portfolio or something.
So,
it's fine.
like above 20%, do you start trimming it down slightly, or do you just let it grow to whatever it?
It does depend, that I kind of, have a 20% limit, but I've been flexible enough to let it go to 25%. But yes, if it crosses 25%, I will book something, for sure. So I've kind of, kept it a bit flexible. So 20 to 25 is what I would have in one stock. If it goes beyond 25, I'll definitely sell. And same thing happens with the sector also. Sector, my upper limit is 25, but it can go up to 30%.
Okay.
Beyond that, I will sell. Okay.
Okay.
For sure.
Okay.
Yeah.
Got it. So I think let's change gear. So let's discuss about portfolios like screening. So I think with cyclicals, a lot has to do with being at the right place at the right time, right? You can basically enter something and then sit for years. So what is your screening process? What are the various tools that you use? Are there any people that you basically look up to see what they are doing, or any of those things that you use to screen stocks?
No, so again, I kind of, basically, it's not that I don't respect anybody else, but then I understand that, I am wired differently, and I can't do the same things which others do. I do respect a lot of people. I do look at what they are doing, but the conviction has to come from within. I will definitely not tell anyone. That is what my style is. Over the years, I've kind of learned that, because I can't scale if I'm telling somebody, for sure. So that conviction, you have to build it for it to become 5-10% of your portfolio. And this we are talking about, sufficiently large portfolio. For somebody with a smaller portfolio, this 10% might not be, that significant in that sense, because there could be possibility that they are younger and they have the best earning years from their business or work, or for them there is a steady income flow, and they can keep on adding to the portfolio even if they, so that they can take higher risks, higher allocations. Whereas for somebody like me, who has a fairly decent sized portfolio, and for me, this is my main source of income, and I'm kind of not have too many years of work left. So for me, it is completely different. I can't take those risks, which a young investor or a smaller portfolio can take. And that happens with everybody, all large portfolios. They will always have, this kind of strategy. So, so that's how I look at, constructing my portfolio. And
so,
yeah.
Basically, I wanted to understand how do you start looking at something? So basically, there are, like, if you look at the number of opportunities available, right? There are humongous. There are so many, but then you have to like start somewhere, right? So how do you like figure out, okay, this is the sector that I want to look at right now, or this is the company that I want to study more, or yeah.
Yeah. So again, so I've talked about in my previous talks, this thing. I've talked about triggers. Okay. If you understand industry, if you understand sectors, triggers will come up. I'll give some example. In 2015, for example, let's take the sugar sector. Okay. So it was second year of bad monsoon, right, in India, and so that was one trigger. Then Brazil, again a large producer, they had a failed crop, so that was second trigger. Those two triggers are fantastic triggers, so that a lot of supply will not come. So if you understand demand, supply, and all these triggers will throw up, and that's when you start looking at the sector. And I have explained in my videos, how you screen, what is the approach I take, and so on. So across industries, triggers will throw up. For example, in chemical, this China plus one strategy, that was kind of a trigger to look at it. And so you will find triggers different point in time. Metals, there were triggers. A lot of production, a lot of mines kind of closed. So those things are triggers which if you understand cycles, you kind of have an ear for this kind of things. So that's how something comes up at the ideation stage. I mean, it's mostly not stock specific. It is mostly sector specific. Sometimes it could be stock specific also, but it is sector specific.
Got it. So just on the related question, so if you look at some of the triggers that are playing out right now, so for example, in the power sector, right, you have an electricity amendment bill, or maybe in the railways, you have a DFC, dedicated freight corridor. So basically, just wanted to, because we are already talking about that. So do you think it's a good time to look at power stocks? Or do you think it's not a good enough trigger to basically for someone to look at it?
No. So again, I think power and all that, I think feed off economic growth. I mean, you will have higher demand for power if there is economic growth and all that. So basically, first you have to understand whether the economy is going to do well or not.
Right.
Unless the economy doesn't do well, I think these sectors might not do well. And I'm kind of quite positive on the economy doing well.
Okay.
So anything which benefits from the economy doing well and which are available at decent valuations are definitely something to look at. So power is definitely something to look at, because there are valuations which are quite good in this thing. So you could actually take ancillaries. For example, if you're looking at power, you can look at somebody who's going to be supplying to power companies.
Okay, got it.
So you could
more like industrials or an electronic meters.
Like you could look at industrials. You can look at if the power sector is doing well, instead of betting on the power sector, which is also a fine strategy. I'm not saying that is not. But if there are too many government companies in it, you might not be comfortable. Then what you have to look at is, are there any ancillaries? If there is going to be so much demand for power, there will be requirement for transformers. So you could look at transformer companies and so on. So that's again, everything you have to look at valuations. For example, if you're positive on real estate, either you can invest directly into real estate, which is what we have done, or there are people who have looked at people who will be supplying building products to the real estate industry and all that. So it depends on where the valuations are good and how much comfort you have with the different companies in the sector. So ours is we are quite open to look at direct plays or indirect plays, but for us everything boils down to valuation.
Got it.
So, for example, building products and all, we like a few companies, but we find the valuations are not good. So, we will not invest in that. Over the last, 1.5 to 2 years, you see how the market has done, right?
Right.
So, the key thing what we have done is we have, increased the percentage of saying no.
Okay.
Whenever new ideas come up,
I
think it is very, very important. You have to learn to say no, because in kind of markets, there will be a lot of opportunities, so-called opportunities rather, which will come, and this looks very great. This looks like AVP. You have to learn to say no. You have to learn to understand this thing. Let's say I was reading a note just a day back about some mining company, okay, which is mainly into lignite mining and all that. But there was a note going on in this that this is a EV play because it mines lignite.
Yeah.
You have to, it mines lithium and so on, but you have to look at what is the percentage of revenue it gets from lithium. Right?
Makes sense. Makes sense.
You can't. So stories will be flying.
Right.
You have to say no.
Right.
That is very, very important. And I think this year we should be very, very careful in selecting what we buy. We should be very stock and sector specific.
Got it. So since we are on that topic, what are your so I'm sure some of them will be like company specific, but then any general checklist that you can share that basically helps someone to say no?
Yes. So let me bring that in my presentation.
Sure.
I have a presentation.
Sure.
Let me share the screen. Just hold on for a second. Oh, host is disabled screen sharing. Can you enable it, please?
Sure. Can you try now? Okay. Awesome.
So I will directly go to, I think, okay. So I'll just tell you what are for stock evaluation, what is something which you use. So this slide is something which, we kind of look at most of the things if we can find this thing. So this is kind of a checklist sort of we have. So any stock which will come in our portfolio, we will look at least 5 years of annual reports. That's a minimum if possible. I mean, so maybe, as I said, with my first 1% allocation, this will be there. For the next 3% or 4% allocation, I will probably go, another 5 years or another 10 years down the line for all the annual reports which I can find and so on. Build that conviction. But this is the minimum we will do this thing. Again, so this looks that a lot of work and all. Over a period, if you ask people who are in the industry for a long time, you understand that reading the annual report, okay, takes far lesser time for somebody who knows what to look for, right? So that comes with experience, obviously. So it does look very humongous that 5 years of annual reports, but it takes far lesser time with experience to do that. So that is what we do. Minimum 3 years of on-call transcripts, if available. Most of the time, we will invest in companies where there are on-calls. Of course, there could be exceptions. There are good companies who don't do on-calls. So that is not a hindrance. But if it is available, yes, we will look at least 3 years of on-call transcripts. Again, see, you buy stocks on what can happen in the future, not what the current numbers are or what the past numbers are.
Right.
So for us to understand the industry, so future potential, how can you gauge? You can gauge if you understand the industry and you understand the company, okay, and you understand the cycles. A lot of people say that they stay away from cyclicals. Now cyclicals is, I say that 90% stocks are cyclical. So how can you stay away from cyclicals? The degree might vary. Okay, there will be some which are commodity cyclical. There will be some which are market cyclical. There will be some which are economic cyclicals. But cyclicality will be there. Okay, so you have to understand what are the different types of cyclicalities and. Sorry for that. I had put it on silent, but somehow it's not gone. So different types of cyclicalities are there. You have to understand that to gauge what is the future potential. Okay. Again, what we look at is what is the promoter holding and how much of it is pledged. This is one important thing we look at. If there is too much of pledge, we really think a lot before we would want to invest. I mean, most of the times it will be a no. Low promoter holding also we do not like, but it's not a deal breaker, because there will be certain companies where it could be just a first generation entrepreneur and he's kind of uh, uh, didn't have money to start, so he obviously did had to do dilutions, and so that could be possible. But most of the times you would want higher promoter holding. If it is low, then you need to understand why it is low very properly. So that is management quality. This I put it a bit in bold. It's very, very important. Management quality should be above average. I mean, this I've learned making mistakes over the years, where in the past if I compromised on management quality, uh, the outcome was not very good. It has happened to me and to most of the investors. So that is something we learn over time, and that is something which I have made non-negotiable in my investment right now. If the management is not good, I will not invest for sure. So again, no compromise in corporate governance. Even in fact, for my investment, I might even go for above average. But for our firm's investment, it has to be not above average. It has to be excellent. So that's what we look at.
So just on that corporate governance, a cross question. So essentially, there could have been mischiefs that would have, let's say, done like 10 years ago. Is it still like a deal breaker, or do you think that managements change and then corporate governance slowly improves? Because there are counter examples to it as well, where like there were corporate governance issues but have made a lot of money for the investors later on.
Yes. So I'm not saying that anybody with a bad corporate governance will not make money for you. Okay. It's just that, how comfortable you are with. The problem in these kind of things is, even if you like it, valuations are very good and you think that they change, do you have the conviction to scale it up? That is the problem we find a lot of times. So as far as our firm is concerned, we will not compromise on it. We will let it go. I mean, because we just need 15 to 20 stocks. So there is enough choice available, right? Why would I,
makes sense.
Go on something? But let's say, there was a previous generation running it. Okay.
Right.
And there is a new generation which has come in, and which these issues were from with the past generation. The new generation understands that, communicates it, and basically there is action on that front, that yes, these issues are going away or are no longer there. Yes, in fact, those are places where you make most of the money. There's one company, okay, where there was very, very average management quality. There were not corporate governance, but the management quality was quite average. So this is auto ancillary company I am invested in.
Okay.
So few years back, the next generation came into the picture. So this company has been doing well, but it's never been able to grow beyond a certain scale. And the older management were kind of Lala types. Again, they've been giving dividend, they've been performing well, but that hunger for growth and understanding, since you are auto ancillary, you need to understand that how the changing scenario and the disruption is going to affect you, right? So I found that maybe the older generation will not affect, because a lot of their revenue was coming from products which will get impacted. Okay. Then few years back, I saw the new generation. I was attending the con calls, and this company was always available at very, very, very good and cheap valuations. When the new generation comes in, I could see the change in their thinking, and I could see their plans to diversify and all that. And that's what and I could see that in action over the next few quarters and so on. So this is when this stock, if you bet on it properly, you understand this stock can be a multi-bagger, and it has been. So these things, yes, but you need to understand what are the changes. If it is the same old promoter, okay, who is saying that I will change and all that, we rather,
Mm.
would want to see it in action,
Got it.
and then take a bet, but we will not go on, just because they are saying that they will change. Most of the times, market will not reward them also. So
Got it.
there is, for these things to be, looked at, or where you can make adjustment to this particular principle, is when you see a management change, or so let's say they bring in a professional CEO, or if the next gen comes in and which is promising. These are the times when we would, consider that. If it is the same old promoter or something, we can't be sure that they will change. So that's why we will either, wait for it to happen on the ground, and then, basically think of investing, or we will pass it on, because again, uh, there are many opportunities which are available, and I will always have limited capital, right? So why should I bet on something where I'm not comfortable? It's as simple as that.
Makes sense. Makes sense.
Okay. So next is again operating cash flows. My partner Nitin has done so many seminars on cash flows and all, and he's brought through examples of things which where there were profits but no cash flows, and things have gone south for a lot of these companies.
Right.
So we look at operating cash flows. This thing, the profits you see has to basically turn out in the cash flow, right?
Makes sense.
There could be instances where there could be investments and all, capex and all that. So that you have to understand. But you would want, at least over a period, you want operating cash flows. So in all our reports also, we will put basically a table of net profit to operating cash flow in all our reports, because we find it quite very important to, and we will color code it, and that's how we put it in our reports. It's very important for us. Again, debt levels, what are the, so this can work at two
right
levels. Okay.
Two ways order,
so
yeah.
either it can kill you, or it can give you a great multiplier. Okay.
Exactly.
So it really depends on which where in the cycle you are. Okay. If you are going to be in a down cycle, that can kill you. Okay. It has happened with so many companies in the past, for example, and where if you can get in during up cycle, that high debt can be a great boon for investors. So I will give example of this. Let's talk about the steel sector. Okay. 2015. Okay. Prior to that, few companies already gone into NCLT and bought by others, right? I don't want to name the company, but we all know there are quite a few companies who went belly up because of the debt, and basically they went through the NCLT process, and banks had to take a haircut, and it was not a good ending for a lot of people, banks as well as promoters. They lost their companies and so on. Okay. Whereas there were some companies who kind of still survived that, and this I'm talking about 2015, and we spotted one company like that, okay, which had a market cap of 200 crores, which had a debt of 2,400 crores. Okay. Now, what happened is, if cycle would have been, cycle would have continued, this company would have not been able to survive, right? But if you are confident that the cycle will turn, this is a company which went up 30x, okay, for us. So this 200 crore market cap became 6,000 crore market cap at the peak. I don't know what is the market cap right now, because we have kind of exited it and so on. Of course, we didn't make the 30x, but we made over 2 periods. We kind of got in at 60, got out at 500, again got in into the same stocks around 200, got out at 1200 to 1300 levels, though it went all the way to 1800. But we got out at 1200 to 1300. But this is what could happen. That could be a killer as well as a great
You can like a multiplier,
will multiply your money. So, so understanding that is very important, and that will all happen if you understand the cycles.
Okay, so sir, just a cross question on that. So with these types of companies, so what we see a lot of times that most of these metrics, like I'm talking about selling. So like when you're in the selling phase, generally the numbers, when they come, even though they are like stellar numbers, the stocks start correcting even much before them. Right?
Absolutely,
so then
absolutely that happens, and that's where I'll bring in some slides. I'll talk about this. See this. So when playing cyclicals, what do we have to comprehend? Within the stocks and sectors, you have to comprehend business cycle as well as market cycle. They may not coincide. Okay. So do make your adjustments accordingly. Best price may come before best results, and worst price may come before worst results. This we have observed over the years. So there is no exact science of selling in that sense. So I have talked about various ways of selling in this presentation, but I can show you it in the presentation, or I can talk about it. So there is no exact science. The problem we have is that all of us want to sell at the top. That is the problem we have as investors. Okay, and all of us want to buy at bottom. That is the biggest problem I have seen across people. Why? I mean, for me, if something has given 10x kind of returns, this thing, I'm fine leaving the last 2x. Okay, even if it doubles from what I've sold, it's fine because I've made 10x. That is more than enough for me. Also, you would look at is that for example, let's say I got in this stock I was talking about. We got out at 1200 to 1300. There could be multiple reasons for getting out. One is you are uncomfortable with the valuations. You are not sure of how much long the cycle will last. Okay, or if there are better opportunity. There could be some opportunity where you think that your risk reward is better. So you exit for those reasons also. So that's why I say you don't have to basically try to get out at the top. So as I said, you don't have to get in at the bottom nor get out at the top. Everything boils down to risk reward ratio at any point in time. Okay, and other opportunities available at that point in time. So that's how we do our investing. We will always periodically assess the risk reward ratio, the margin of safety, and accordingly take calls. Other ways are you get in. You can look at a few ways. If you want to make it a bit scientific, you can get in at certain price to book, get out at certain price to book. For example, bottom of the cycle, these companies will be available at 0.3 of book. And in top of the cycle, it can go to 1.4 to 2, for example. So you can structure from past cycles. You can get all the data. You can say that okay, I will get out at 1.2. That would have still made me a 4-bagger, or I could or same thing happens with replacement cost. So you can have strategies, different strategies for yourself. You can have trading stop loss strategy.
Like since you talk about price to book, what are the other key metrics? So because how I understand is these metrics are very sector specific. Some sectors have different metrics that one should look at. For example, a cement might have people look at EV to EBITDA, or a bank you look at price to book. Exactly. So like what are the major metrics for any newbie that you might want to highlight?
So again, so price to book is one. Okay, EV EBITDA is one. OPM's operating margin is one, which is another metric. Capacity utilization you have to look at. So you basically have to combine all this and come up with a solution for for a particular sector and so on. So either it could be a mix of that, or you could track just one or two. We actually look at all these things. Okay, so we have certain you know what do you say templates which use for basically, and that's where we come with a score and so on.
Okay.
Again, so that is something which we do a lot. But then most of the times, I will tell you that we can't get out at the top, nor we could get in at the bottom. Okay, we still can't do it, and I don't think we'll ever be able to do it. But so that's why I say you don't have to be exactly right. Even if you're approximately right, that is good enough, and that's what we try to aim for.
So I think that's a very good point. So you have to be approximately right. But then how do we avoid being absolutely wrong is the question. So how do we know where in the cycle we are for a newbie? Because I think that is where a lot of people like end up losing a lot of money because they enter at the wrong time.
So again, as I said, if you look at all these things, okay, you look at, for example, operating profit margins, that will give you a picture, okay, where we are in the cycle. Okay. You have past cycles, right? There's so much data available right now. Previously, we had to, basically kind of, crunch the data ourselves. But now with Screener and which my friend Ayush, have
true.
Created, it's amazing tool.
Like,
I mean,
hats off to them. Like really excellent tool.
Hats off to them, right? So much data is available. You just have to basically look for it. You have to understand the business. The thing is, it is not very difficult if you can control your greed and fear. Okay, and that is the most important and the most difficult thing to do, to be honest. Also, but if you can, and as I said, no, you don't have to basically be absolutely right. You don't need to be. The thing is, what you said, you don't have to be wrong. Okay, and that when will that happen? When, and I'll give you an example. You'll be wrong when it's a very good example. Okay, so this is a stock. Okay. So at 4,500, can you see the chart?
Yes, sir, I can.
Okay, so at 150, the PE of the stock was 150. Okay, at the price of 150, the PE of the stock was 150. It was doing an earning of 1 rupee. Okay, this is an extreme example, but I just want to bring out very important aspect. At 4,500, the PE of the stock was 5. It was earning more than 800 rupees. Okay,
right.
All this happened in just less than 2 years, right? Now, if you were to look at PE, you would have invested at 4,500, right? And a lot of people did. Okay, 4,500 or 3,800 or something. Now, understanding that PE is the worst metric to look for, this is a fantastic example for that. So, what do you look at? You look at what are the you look at the margins. This will give you a better picture always. Okay. So when you know that something is doing 63% of OPMs or 50% of OPMs, you know that it is not going to sustain. So you don't get in at that point in time. At this point, the ratios are superb. Okay, the ROE is superb, the ROC is superb. All the earning ratios are superb. Right. So people will say that, oh, this is a fantastic company. This is earning this much ROE and this much. You have to understand that these are extraordinary earnings and extraordinary return ratios.
So just a question on this slide. Sorry if I interrupted you. On the same slide. So if you look at the 2018 numbers, right, the operating margins went as high as 63%. Right? So it was definitely not a good time to enter the stock. But then maybe it was a time to exit. But if you look at 2019, the margins expanded even further. right? They
Yeah.
went up to 71%. So
Right.
then, my question is related to the length of the cycle. So how long will the down cycle be? How long will the up cycle
So
be?
again, yeah. So again, this you show, if you look at the quarterly numbers, this will not be over 2 years. Okay.
Hmm.
This will be maybe 5 or 6 quarters. Okay. And I remember doing seminars in 2017, 18, and 19, and where questions were asked to me about this company, and I had told that in my experience I have seen these kind of margins not last, and this I call as, something which might be right term or wrong, but something which I have introduced the first time: whiplash cycles. So whiplash cycles just don't last very long, is what my understanding is over the years I've seen. So this was kind of, basically a cycle which was like a whiplash, that, just margins went through the roof. And I've seen that they will not last long. So again, here, and I'll be frank enough to admit that, I kind of got into this stock, okay, around 170, and I exited the stock at around 1400. It went all the way to 4500. So I exited early. I submit to that. I've said that openly also, that I exited early. Okay. And that is again a learning which you have, that these kind of cycles can take the stock to much higher prices. So that is where, I kind of introduced the trailing stop loss method in my mix of, strategies. So ideally, I would, put a stop loss like, that, if the stock corrects 20% from the top, you get out. So that is 15%, 20%, 10%, depending on your risk appetite and this thing. So that is when I introduced this, and this has worked for me in future. So key learning for me also was that, though I made, 8x or something on this stock, I could have made much more. I could have made a 20, 25x, right? So again, there is no such thing that you are expert in anything, right? You keep on learning, you keep on adding strategies to your armor.
Just a question, just a question on the same thing. So since you said you keep on adding strategies to your armor, so what are some of the other strategies that basically I'm looking for triggers? So I know, like in last presentation you talked about like a capacity expansion by a lot of players is one trigger. So what are some of those triggers that you keenly look out for?
So again, cycles play out and work for you if you understand supply and demand. That is the core. Okay.
Right.
So that is what will drive, margins. Okay. If there is huge supply, margins will come down. If there is short supply and huge demand, margins will go up drastically. Right. That will happen. Now, if you can keep a handle on this thing. Now, in this particular example, you know that, when there's these kind of margins, you attract a lot of players. Okay. Again, sometimes you know that for some products, the plant can come in, let's say 3 months, right, or 6 months. For some product, it will take 2 years, right?
Exactly.
So know you have time. Okay. But then the correction will start sooner than the plant actually comes into production, right?
Makes sense.
So again, all these adjustments you have to do. Okay. And there is no exact science. For each sector, it could be different. For polyfilms, it takes minimum 18 months to 24 months for a new line to come in. But the derating, or basically the peak would come much before those plants come in, because market is also forward looking, right? So there is no exact strategy and science, and it all depends on your judgment and influences. So if people are looking for, to make it like a science where there are, exact parameters and all that, it is not possible. What I feel. So and you can't optimize it to a to a great extent, in the sense that I will be able to get out at the top and get in at the bottom. I have seen that is a futile exercise.
Mm.
Uh, so my uh, goal is that if I can get anything um, between 20 to 25% above the low and sell at 75 to 80% of the high, I am more than good enough.
Mm.
Okay.
Mm.
Cycle.
So,
So that is the benchmark I have set.
okay.
Most of the time I'm not able to achieve that also. Okay. I will sell something at 60% of the top.
Mm-hmm.
Uh,
Got it.
that is possible, and I'm
Mm.
fine with it, because I still would have made a lot of returns
Got it. Got it.
just doing
So,
this. Yeah.
just a question on something related to that. So, if you look at textile as a sector, right? So, if you see like India's share of export is rising, right? So, a lot of players are announcing capex. So, does that ring bell to you, or do you think it's more of a structural story and it can continue for next like a few years, and it's still not time to start thinking about the exit?
So again, it's very difficult to know that how long this will keep on playing out, right?
Mm. Mm.
This China plus one is definitely something
Mm.
which we think is a reality, right?
Right.
For textiles, there are so many other factors, preferential treatment
Right.
companies have, and
Mm.
so on. So, for example, in garmenting, Bangladesh and Vietnam
Mm.
have better trade treaties with
Mm.
EU and so on
European.
and
Yeah.
so on. So you have to basically look at all those things. There will be certain segments where we are leaders and we are doing well. So so you look at companies where you won't be disrupted by these things. Okay, that so a lot of it will also hinge on some of these preferential treatments going out. So again, that we don't know whether it will happen or not.
Mm.
Uh,
Mm.
uh, uh, for certain areas, India has been doing well for a long time, and now demand has picked up. A lot of it is, demand has also picked up,
Right.
and there being, disruptions in
Mm.
shipping and all those things coming into play, shutdowns and so on. Somehow, I think whatever people might think, we have done a great job
Mm.
in capturing these opportunities. Now,
Mm.
will this be permanent or not? That is something too early to tell, uh, as far as I know. So I will be, basically, I would be cautious in investing any new capital,
Mm.
but I will definitely hold on to what I have in
Mm.
that sector,
Got it.
uh, and
Uh,
keep on evaluating in the future, because I can't predict the future. See what is
right.
going to happen, right?
Right.
So
Right.
what
Right.
I can do best is, what is happening and keep a track of that.
Mm. Mm.
So and understand the variables at play.
Makes
Okay,
sense. Makes
and keep
sense.
on tracking those. So understanding those variables is very, very important.
Mm.
So for example, these FTAs and so on,
Mm.
preferential treatment, that those are things which you have to keep on track.
Mm.
Cotton prices, yarn prices are variables which you have to keep
Mm.
on tracking,
Mm.
and so on. You track the variables and then keep on, basically uh, looking look at it quarter on quarter,
Makes
every
sense.
quarter.
Makes sense. Got it. So a similar question on another industry, which is, so I mean, there are certain industries where the supply is very, very fragmented, right? Similarly, demand, and it is very difficult to keep a track of demand and supply. Whereas there are certain industries where there are very few players. For example, a telecom, or let's say a MDF play, where there are like few players, easy to see the supply. Uh, so talking about MDF, so let's say a lot of, if you look at players now, like Green Panel, Rushil, or sorry, not Rushil, like Greenply, those are basically doing capexes. They might come online in next 2 to 3 years, like takes almost 2 years. So then, uh, is it so since this takes like at least 2 years, is it a good time to like keep sitting, and then, because at least for those 2 years, you know that the numbers will be good until the new supply comes. So how do you evaluate selling like quarter to quarter?
So again, I think it will, this is a sector which I don't have investment in, to be honest. Something which I kind of missed. Okay, there are so many sectors playing out. You obviously will miss some.
Right.
So this is something which I missed. Let me make a admission first. Okay. Uh, uh, I have been tracking these companies. Now, what has happened? It did look interesting, but by that time, my stocks had moved away from my comfort zone. Okay, so I kind of skipped it. They have gone up higher. From there, that's a different story. But I didn't have the comfort to invest when things were clearer to me. Okay, now about new capacity coming in. Okay, in 2 years, so we don't know. I mean, when the derating will, happen. Now, what you have to look at is demand here. If the demand is enough that it can absorb this without capacity utilizations coming down, okay, then I think the cycle will continue. It's as simple as that. So you have to estimate the demand, okay, demand growth, and what is the capacity addition, and then accordingly you will take a call whether to stay invested or at least be cautious or so on. Also, if there are any, you have to see that if there are export opportunities where all this new supply which is going to come in can get absorbed. So these are the variables you have to track.
Got it.
You talked about telecom, right? So telecom, again, this is a sector which we like. I mean, I think I was one of the first guys to look at telecom a couple of years back when it shrunk to a 3-player market.
Right.
It was purely contra call from our side.
And I would really like to thank you because I invested in the sector because of you, because you were talking about it on Twitter. And then I realized that is right and made some good returns there.
Yeah. So it was purely a contra call. Things were really, really bad. Now you have to understand. So I travel a lot. Okay. I've gone to small countries also. Okay. Like a small country like New Zealand, for example, has 4 telecom players. Okay. Population is what? 6 million or something? Not even 6 million. Right. For such a small country, there are 4 players, and across the world, I've gone through.
Right. True. Even if
very,
you look
very
at in US, sir, US like the
3 or 4 players.
Yeah. So even in US, the rates are so high. In India, they are like I think the lowest in the world.
Right. So that is one thing. The rates were unsustainable. There was obviously predatory pricing and all that. So and that's why 13-3 happened. Right. People just couldn't sustain. Now, the thing is, could it have become a 2-player market? Yes, it could have. But do you see it becoming a 2-player market? It still could. But at least the government has shown intention that they don't want this industry to die. You know what has happened in the last few days and all that. So the 3rd player might survive, right? Would I invest in it? No, to be honest, because for me, if there is a 36% dilution just on the interest of the deal, okay, it still doesn't make sense for me. It's a hope trade for me.
Right.
Okay, I have been invested in the pure play player. That is our largest holding in our portfolio also. So we kind of think that this, and we were quite sure that the prices will not sustain. You also have to understand the politics behind it. That government will not want it to be a clear market.
Right.
So all these things helped in building my conviction, despite all the AGR cases going on and on, it being in Supreme Court. And,
right. So
if you understand these things, you do take a contra call and say that it's not going to be a single player market.
Right.
At that point in time, some of these companies were priced in where it was as if it's going to be a single player market, which I think the government would not let it happen. We were very sure of that. So that is why we took the call with the pure player, who is the largest and the best.
Right. Right. So, so if you look at the telecom sector, I think the future is still bright, right? Because now it's a two-player market. You know that rate hikes will come for next several years. They're bound to come. So then, basically, do you think like most of the juice has been taken out, or basically you think that now because the pricing power is there in the sector, right, it can continue to churn good cash flows in the future? Because so far if you look at, they're still not profitable, even though the cash flows are doing better.
See, as of now, I think it is something which will not sell at all in a portfolio for a very,
Right,
very long time.
right,
Okay.
right, right.
I have talked about it for the last 2 years that this is for me very few times there comes decadal trends. So I kind of call it a decadal trend at least,
Makes
if
sense.
not more.
Also
And
if you look
there
at
are multiple reasons for it because we are a data hungry country. Okay, in digitization we are number one in digital transactions in the world. Okay, all that is going to require data. So yes, there will be 5G coming in, there will be capex, there will be all those things will happen. But then prices have been rising, and we are seeing ARPU is going to 300.
Right, right. Also, I think the
and you can
capex will
imagine the
be
cash flow it will grow. Yeah.
right, right, right. So also, if you look at the capex would be much lesser with less competition in the auctions, probably, right. For the 5G, the capex would be much lesser than the 4G that was done.
Yeah, let's hope so. And we think that there will be a level playing field now. In that sense, we know what has happened in the past, uh, where one incumbent player actually got some advantage.
Right.
But with 5G, I don't think that is going to be there.
Okay. Now I think let me talk about a more general investing aspect. So you being from a non-CA, non-MBA background, do you think there is a disadvantage of being because like, or do you think it's something that you can like easily learn over time?
I think you can learn it over time. If you have the passion, you can learn it over time. I think that not being a CA or a CFA has not been a handicap for me. Uh, in fact, being an engineer has been a big positive for me, is to be honest, because uh, you can understand technology much better, is what. And this is a world of technology. So I think it affects all companies where you think that there is no technology involved. Automation is affecting all companies. So if you understand these things, if you're an engineer, they have a better chance of understanding these things. So yes, there are positives. Obviously, you will not be as fast as the CAs and FCAs in with the numbers initially, at least. But over a period, if you learn it, I mean, they've also learned it. So why can't we? Is
Right,
what
right.
my philosophy is. And also, it is important that you don't look at too many numbers. To be honest, a lot of numbers are actually useless. You should know what to look for.
Interesting. So basically talking about the behavioral aspect of investing, basically I want to understand how important is that, and then over a period of your the entire journey of you basically being an investor, what are the things that you used to do, but then you were basically, I'm talking about the behavioral aspects that you changed and then now you don't do, or some things that you started doing in terms of how you evolved over a period of time.
So as I put that slide here, know yourself,
Right.
Right. I think behavior is 80% of investing. Okay. As far as I am concerned, that's what I do. I mean, investing is multidisciplinary. I think more than finance and all that, psychology and history helps you a lot more. Because finance or the numbers, everybody can look at, right? What is the differentiator? I mean, this data is available to everybody now at the tip of the finger.
Right.
What is the differentiator between a good investor and the and the average investor. Okay, there are two things. One is temperament, and one is influence of the data.
Exactly.
Okay. So data is there. In fact, we are overloaded with data. Okay. So I mean, so a lot of it is noise, obviously. So you need to be able to figure out what is noise and what is signal. So that also you learn over time. Over a period, I have kind of learned to ignore certain things and look at certain things. Even when I'm looking at the annual report, or even if I'm reading a con call transcript, and so on. I think that does come with experience. Over a period, uh, uh, so data is there for everybody. Let's get back to what I was talking about. Data is available with everybody. What is different is, what inferences you make from the data and what is your temperament. That is the most important thing. Uh, so in my previous interviews, I've talked about, there are basically four players in the market in that sense. Okay, so there are the institutions. Okay, there are value investors. One bucket. The institutions would be, mutual funds, FIIs, and so on. The PMSs, AIFs, and all that. So that I will call them institutions. Okay. Then there's a bucket called value investors. Okay. And even growth investors would fall in that. Okay. Then there's a bucket called, speculators, traders, and so on. And then there is a fourth bucket, which is basically tip seekers, or I don't know what I'm doing in investor, right? So I always say that, you can be any of these buckets, but the fourth one. Okay. I believe there is a place for everybody in the market, for all these three things. So typically a value investor, this bucket would actually sell it to bucket number 2 and bucket number 3, and over a period you try to evolve strategies where you try to sell it to bucket number 4, which is the tip seekers. Okay, so my evolvement has been, I would initially sell it to bucket number 2, which is the FIIs, the institutions. Okay, over a period I kind of understood that, valuations, if you look at, valuations never remain in the fair range, right? Either they are undervalued or they go hugely overvalued. So I would sell at fair value. Okay, buy at undervalue and sell at fair value. Over a period, you kind of realize that, you need to sell it higher. You can sell it higher if you understand what is happening. So then so instead of selling it to bucket 2, you sell it to bucket 3, which is basically the momentum players and the technical guys. And I kind of realized that, these people also need to make money. Okay.
So I think whatever you said makes sense.
Can you evolve a strategy where you're selling into the fourth bucket? Though most of the times I'm selling into the third bucket, right? This thing, I'm happy doing that. Because the risk increases as you go from one bucket to the other. Okay, so by the time you're in the third bucket, your risk is much higher. Even if you are from value, this thing, risk of holding for this position for long is quite high.
So I think whatever you said makes sense, because if you look at retail investors, a lot of them look at if the mutual funds are invested or not, right? But I think at your level, you basically are at a level before that. You try to see that, okay, you might not be looking at if the mutual funds are invested or not, is what I'm thinking.
Yeah, no, I mean, not necessary, but ideally you would want to, get in before the mutual funds, right?
Right. Makes sense.
You, as a value investor, you would want it. There will be value funds who will be obviously buying at value also, but most of the times, ideally you would, if your style is like that, where you're playing contra, you're playing, peak pessimism kind of investing, this thing, you are buying when the mutual funds are obviously not buying, and that's when valuations are very good. So obviously you are buying before them most of the times. And the key is, having patience. Okay, right. You talked about before also. A lot of times, And that's why in my processes I've talked that you need to do a stress test for each company you invest in, especially in cyclicals or the deep cyclicals, is whether these companies can survive another 2 years of downturn. Okay, because you can't be sure when you're buying at peak pessimism, you can't be sure when the cycle will turn. Okay, okay, you are just putting that 1% in that time, right?
Okay.
And you are scaling it up when you see that cycle is turning. Okay, and that you do or you come to know by if you're tracking demand and supply. So some supply is going out, obviously, and demand is intact. You know that prices will start moving up. So that is when you scale up and so on. So so ideally, most of the times you are in bucket one, and so that's the kind of investing I do. I obviously believe that there is a place for everybody except the fourth. The fourth ones are the ones who make all the other three.
Happy. Got it. So, a question, some general questions related to investing. So, do you have any preference of investing into sunrise sector, or if you find something that is really cheap in a sunset sector, would you still give it a try and you don't mind if it's a sunrise or a sunset sector?
Again, so sunset sector. Okay, if I'll be very honest in telling you, sunset sector. Would you call coal mining a sunset sector?
Yes, I would. Yes,
right?
Yes.
Okay, but I would invest in it if the valuations are right. Okay, because I know that I think coal is not going away for at least the next 10-20 years, right? And if I can get enough returns in those next 10-20 years, just by the way of dividends, okay, if I can get a 8%, 9%
dividend,
sustainable dividend yield, okay, I would invest in those companies.
Makes sense.
This thing, as simple as that. I wouldn't mind investing in, or would you consider a cigarette company?
Maybe like a petrol or a gasoline company. So know that petrol will get disrupted. Like EVs are coming, so like a lot of people just like stay away irrespective of the valuations from like the entire.
So again, it depends. So for that, those kind of investments, I look at can I get 7-8% dividend yield for the next 10 years?
Okay. Interesting.
If I can get it, I'm fine, because I know that this will not go to zero, right?
So even though the dividend yield might be high, the stock might still keep correcting, right? Or do you think that the dividend is so high that like it doesn't make sense for the stock to correct because the dividend will like increase even further?
So again, so you buy absolutely when things are where you think that it can't correct more than 20%. You think that.
Got it.
So that is what I will look at, and this 20% correction worst case I will get back in 3 years through dividends, right? So that is fine with it, because but for that you have to understand that these companies are going to be around for another 20 years, despite all the hype of solar
renewables or EVs,
and that for that you have to understand what is happening in the Western world also, right? What is happening in Germany, where they have gone too much into renewables and now having problems. So yes, this is a sunset industry, but we think that thermal power will be there for another 20 years, for at least. And if in 20 years, if I can get a good sustainable dividend yield, and what might also happen is just because of this, there could be a lot of players who go out of the market, and then there will be a shortage
in power.
And that is what happened with coal last year. So there would be opportunities also. Some companies abroad went up as high as 600%.
Right.
They will return of 600%. So it depends. We don't say no to anything, but then there are a lot of criteria we look at whether dividend yield for these companies. Yes, dividend yield is one of the
makes sense. Makes sense. So your thoughts on new age companies, like won't name them, but there are so many IPOs which are coming for the new age companies. So what do you think? Do you like look at those opportunities?
So in fact, I have talked about only one company till date in any of my TV interview. Okay. And somehow, basically that came out from my mouth, to be honest. And that was one company which listed and which is at 50% of what it was. So during that IPO, a question was asked to me. I said, I will definitely not invest in this company. I think that it is absolutely not worth investing. I don't understand the business model. I don't understand how they will, make money, and so on. So, and this company has halved, but I kind of avoid naming any companies. So some of these companies will do very well. Okay, I understand that. But would I invest at the current valuations? Maybe no.
Got
maybe
it.
no.
Okay.
I think valuations are not comforting for me at all. If some of these companies were to crack 50%, being a value investor, if they were to crack 50%, maybe I will look at it. That's my this thing, because there are enough opportunities available.
True.
Being in what I understand. See, I being a technical guy and being a software engineer, I understand these new age companies very well. Okay, and sometimes it becomes a hindrance also, in that sense that you if you understand too much, you will not invest. So that has happened to me also in some of these companies, to be honest. Of course, we invest in PE funds, so we kind of have investments in some of these companies through our PE fund. So, personal level, yes, there is exposure I have in this segment. And since we are doing it through our PE fund, I don't want to basically invest when it is coming for IPO. I think maximum juice is already being picked.
So
by the PE guys and the
that's true. That's true. Absolutely. Sir, some question unrelated to this. Basically, if you look at like on Twitter or any other place, right? There is such a hype of special situations going on. Everyone is talking about demergers, mergers, arbitrage. Do you track those opportunities? Do you think because they are kind of value investments too, right?
So if too many people are talking about a special situation, it's no longer special, right? So if it is on Twitter, how can it be special, right? So special situations, most of the times it should be a lonely game. If everybody knows about, a special situation, it will not be special anymore, is what I think. Yes, mergers is something which, or special situation we do, but we look at special situations from another angle, in that sense that, if there is a management change or a generational change, we find that also as special situations. Okay,
true.
And that we have seen, make us much more wealth than the mergers or mergers. So we do special situations. Let's say buybacks and so on. So we will advise the client that you buy in retail and this. But now the thing is with so much of social media and all that. For example, one IT company recently announced a buyback. Now so many people have 45 shares in their account, right? So the ratio which is there now, and
true. Actually, one of my friend was asking me yesterday itself. He was saying that such a huge buyback has been announced, but then the price is not moving. So that's what I said. Look at the buyback ratio in terms of how many people will even be able to give their shares.
So yes. So again, that's why I'm saying, if everybody knows about this special situation, it will not be special anymore.
True. So one very quick question on one sector that everybody wanted you to talk about is sugar. So we all know it is a structural story. there are things. So I want to understand from two angles. One is, if you look at any sugar company, they are still announcing new capexes, right? So that is one. So what is your outlook on the sugar sector? And then the second question is, if you look at, because now that the sugar ethanol blending will be done, we know that there might be inflation for some years, right? In terms of food inflation, because if you basically mix the fuel economy with the food economy, right, there is bound to be inflation. So like, are there any places that you're looking for in the food economy that might benefit from this?
So again, sugar, I will still say it is a very, very political sector. Okay. In that sense that, all this is possible only because the government is letting this happen. Now people say that, 60 rupees, 62 rupees, whatever is the ethanol price or something, right? That the cost of petrol pre customs and excise is much lower than that actually. Okay, it's just that the duty. So government is foregoing a lot of duties. Okay, we have to understand the economics that yes, government wants to bring down the import bill.
True.
Because this thing at current price, I think ethanol is more expensive than crude, right? Or petrol, for example. But if oil were to go to 150 or something, then the dynamics change. And obviously, government definitely wants to reduce dependency and, more importantly, reward the farmers, right? I think it is all because of politics that government is doing this. Apart from all these other things are, I think, semantics. Actually, government will makes a loss by blending ethanol. A lot of people have tried to prove that this is not the case, but I will stick to what I say, that actually, because loss in revenue and duties is a loss.
True.
So yes, the government is supporting it. So that is one thing you have to understand first. That, and how long will government support it? Okay, and that is also important. Tomorrow, if so again, with UP elections getting over, will the same government support be there? That is one question you have to. One risk which is there, big risk. Okay, with there has been talk about flex fuels and all that. Beyond a certain point, it becomes your engines might not be able to handle the 20% ethanol. I think is. I have talked to experts and all that, but I've got figures of 10 to 13% blending is which current engines can accept. Now government is saying about 20%. So I don't know how practical is that. And how much damage it will do to the engines. Flex engines and all that, there is a cost to it. It will take quite a bit of time. So it's a good thing that has happened to the sugar sector. Yes, if government support remains like that, it becomes a far less cyclical sector than it was before. So then it can become structural. But you have to basically have the confidence that government is still going to keep on this support. If you see in the past, for example, export subsidy government has removed sometime back. So government will let them survive and make decent money, but it will not let these companies make exorbitant money, because in worst times government has supported them. Is what my belief is. So so at this point in time, I don't know. I mean, for me, the risk reward ratio is better in other sectors than in sugar.
Makes sense.
So we have exited sugar, to be honest. Okay, and I'm not saying that it is a bad sector to be invested in or study over or something. That is not the case. It's just that we found better risk reward opportunities than sugar. Okay, so we were invested last year and we have exited. That is what my thing. But understand, I put a thread also on sugar on Twitter. If you just search for it, I put out all the dynamics which are there. And I do give that it is far less cyclical than what it was before. That is definitely happened.
Interesting.
But politically dependent, yes, it is very much.
Interesting. So we are already out of time. So if we can we like extend for 5 more minutes, is that okay? Or
Sure.
okay, thank you. One more question about the Bob films and the Poppet films, since you very closely track those sectors and you also have a company.
I'm sorry, I didn't get it.
The BOPP and BOPET.
Okay, Polyfilms, yeah.
Yeah, Polyfilms,
Okay,
essentially.
Right.
So for a new investor, so how do you basically track those prices, and where do you think so the Polyfilms? So if you want to throw some light on that sector as well.
So again, Polyfilms is the reason why I got interested in cyclical investing.
Right.
During 2009 and 10, there was a tremendous upcycle in Moped. And I'll show you just a second. Okay, so you see this company. Okay, this company was doing margins around 80% or something, and if you see this during between March 2010 and 11, it went to 36%. For some other companies, it went to 45%, 50%. Just like the graphite electrode, there was a shoot up in margins. Okay, so this is when I played the first, cyclical, and where I made 7-8x returns in just 6 to 9 months in this company. And you can see the profit before tax, which was 156 crores, went to 1415 crores during that period. Okay, so and then you see what happened next year, 188 crores again. So once in a decade kind of opportunity had come that time. So that is when I made fantastic money in it, and that is when I started, basically putting a structure to cyclical investing. And it has been a great journey post that. I mean, this is the first instance where I made fantastic returns. And this, mind you, this was during the time of 9-10, where then nothing was happening in the stock market, so during that time to get something like this. Okay, so post Lehman, I think 2009 to 14, or mid or 2014, nothing happened in this thing. 2013 and to
so sir, if you look at currently,
so the stock market, but in that period, if you can get something like this, that's what made me understand the power of cycles. So just a background on Polyfilms.
Sure.
So Polyfilms, I mean, we have a industry where we are flexible laminate manufacturer. So we are procurers of Polyfilms. Okay, so we kind of know what the price of Polyfilm is, and so we saw what was happening, and
So, sir, a quick question on that. So, for someone who is not in the industry, can you provide some resources where someone can basically look at those prices and
I'm
the
sure
trend?
you can get it. I mean, the thing is, I think price list you can get it quite easily. It's just that you just need to know some distributor of Polyfilms, and you will get it.
Okay.
It's not that difficult. And also, if you see, there are reports coming every month from different research houses, which will give the price of Polyfilms. Okay. Unfortunately, most of the times the prices are wrong, but and I've corrected many times. But these reports are not fully correct, but they will give you an idea. But best prices we want, you can just get hold of some distributor and get prices of them, establish a relationship or whatever. And price list should not be very difficult to get, to be honest.
So, sir, where do you see
and
the
then you have
sector
to track
headed?
the raw material. You have to track the raw material. You have to track the conversion cost and all that, and you come to know the spread. And also quarterly, these companies have con calls, and this spread figure does come out every quarter. You can come to know in the con calls. So either I will be asking that question or something. Though I know, but I just want to hear it from them. If I am in the con call, I will be asking those questions, and others are also asking. So it's not very difficult to get the spread also.
Okay.
So,
Interesting.
what was your further question on this?
I mean, I just wanted to get a sense of where the sector is headed. So if you talk about the cycle, so where in the cycle are we in polyfilms?
So again, so there are two. I mean, there is BOPP and there is BOPET. Again, cycles can run differently for these sectors, and they have run in the past differently. For BOPET, the cycle has started, I think, in 2017. The upcycle started, and it's been in upcycle since then. Okay, just because demand has been very, very good. And what has happened is something which is surprising. So if you see these companies, generally they would have, the margins will go to, like, this is an extreme example, but then for other companies, it would margin will go to 6%, and then go to 12 to 14% during upcycle, and in down cycle it will be 6%. When a lot of supply comes in, it will come down to 6%. On net level, they might be making losses and all that, OPMs. So that has been the history in the past. This is the time when this has gone to 20%. Okay. Now, I don't know how sustainable it will be. Fortunately for them, what has happened is that, due to COVID, there has been tremendous demand, because the need for packaging obviously increases when everybody wants to be, more hygienic, and so they've got a tailwind for sure in the last 2 years. So investment at this point in time, I would not. Will I hold? I have sold some. I hold some. I have booked profits in some companies, and some companies I'm holding. But I would definitely not invest in these prices. Even for the BOPP, the margins, which again range from 6 to 12 during this thing, currently at 17-18%. Okay, and that has been there for last 2 years now. How long it will sustain, we don't know. So again, what I would suggest anybody who is holding on to these companies is track supply, see if there is any demand slowdown, and basically maybe have some trading stop loss kind of strategy in place.
Got it. So last question before I let you go is basically, how does a typical day look for you? Essentially, how does your day start, and what all do you do in your day?
So I sleep. I mean, I get up early, but I don't sleep early. I'm trying to change that. So I generally get up at 6:30. Then I by 7, 9 down playing badminton. We have a good court in our society, so I kind of at least 3-4 days a week I play badminton, and then on the other days walk with friends. Morning walk will be there, so some activity will be there. I'll be back in the home by around 8:45 to 9, and then I'll just get ready, and then market open. So for 1 hour, I'll just look at what is happening and all that, and then I'll be reading, and then I'll basically not look at the prices, whatever. If I have to put any orders or something, or generally I do it in the first hour or something, and post that I don't even look at the markets. And I kind of keep on reading, obviously. During evening and the day, I mean, my lunch will be at around 1, and again, as I said, I don't look at markets. I don't know what is the closing levels and all that. I will not look at. Most of the times it's reading, at least 8 to 10 hours a day is what I will read. I do like to watch web series, so in the evening I will maybe spend an hour on TV. I don't read too much, or I don't listen to too many news. I don't watch too much live TV, to be honest.
Okay. So, sir, in terms of reading, do you read mostly like reports and annual reports, newspaper? Like what is it that you read?
So yes, most of it is annual reports, con calls, and analyst reports.
Hmm.
Most of the times is that I do read books once in a while, but mostly on psychology and so on. I
Any
don't
any
read too many investing books, to be honest.
Okay. Okay. So any books you would like to recommend to our viewers?
Uh, so thinking fast, thinking slow, I think that is one
Daniel
good book.
Kahneman. Yeah.
Yeah, so that is one.
Interesting.
Then I read my Howard Marks
Memos.
and so on.
Hmm.
So most of it is letters. I read a lot.
Hmm.
Uh, Warren Buffett
Interesting.
letters.
Hmm.
So a lot of blogs I will read and so on.
Okay. Very interesting. I think it was a very fruitful session, sir. I think I myself like really learned a lot, and I'm a big fan of yours, of your work, and I think more than that, I'm a big fan of your overall nature, right? Because you, I think, are one investor who doesn't hesitate about sharing his ideas, his thoughts, and basically likes to give to the investing community, and that is what like any viewer, I would really recommend to watch his other interviews as well. I think they are very enriching. You'll definitely learn a lot from those as well. Thank you so much, sir. It was a really pleasure having you here, and all the best for your investing journey.
Thank you so much. It was fun doing this. It was much more interactive than the presentations. And you asked very relevant and good questions. So I must thank you and all the people who posted the questions on Twitter. We might not be able to reply to everybody's questions, but we try to cover as much as we can in the time we have.
Right.
So good luck to all. And the only thing I want to tell is, that uh, uh, be safe riding cycles, wear helmet, don't get into accidents.
Awesome. Thank you so much, sir. Yeah, have a really nice day ahead.
Thank you.
Thank you so much.